6.4 trillion. That is the total amount of US debt due by the end of 2025 that will need to be refinanced. But you might be thinking, okay, so what? I've heard the warnings before, but this time is different, not just because of the sheer size of the debt, not even because of the skyrocketing interest payments on the debt, but because buyers who we thought would always be there are bailing, leaving a vacuum that's being filled by private buying that's creating a ticking time bomb that could unleash the largest financial meltdown we've ever seen. The United States now owes roughly $37 trillion in total debt, a large portion of which is held by foreign governments and investors, such as China, Japan, and other nations. But the bulk of our debt is actually now domestic, held by US banks, Wall Street, and, of course, the Federal Reserve itself. But it wasn't always structured this way. In fact, the recent shift has been dramatic. Foreign central banks used to absorb a much larger share of US debt, helping keep rates low. But as US borrowing needs have increased and foreign demand declines, well, the US is increasingly forced to fund itself, which is why we are seeing desperate moves by the Treasury, such as large-scale issuance of short-term Treasury bills, typically a stopgap or emergency funding measure used to fund regular operations of government. Despite all of this, mainstream media messaging continues to push that there will always be buyers of US debt. But the question we should be asking is, who exactly will those buyers be and at what cost? Over the last decade, the total share of treasuries held by foreign investors has collapsed, dropping from 34% in 2014 to just over 21% today. This is despite the fact that the US, of course, issues the global reserve currency, often referred to as our exorbitant privilege, because it has allowed us to borrow huge sums of money at near zero rates and export our inflation onto the rest of the world. And while this decline has been in motion for years, it reached a breaking point when Washington weaponized the dollar against Russia by freezing and seizing their dollar reserves, showing the rest of the world that the dollar was not a neutral asset. No, in fact, it was a political tool, one that could be used against any country who disagreed with Uncle Sam at a moment's notice. This global realization further accelerated the de-dollarization movement, or a move by foreign nations such as those in the BRICS bloc, led by Brazil, Russia, China, India, and others, to move away from a dollar-dominated system. But nowhere is this clearer than China. Historically the second largest foreign holder of US debt, China has been dumping treasuries as fast as they can and opting instead for a true safe haven asset, one that is actually neutral and cannot be politicized against them: gold. Meaning that the US, instead of having its debt backed by one of its largest trading partners, is now increasingly forced to lean on less reliable buyers. In fact, while China's holdings of treasuries have been cut in half over the last decade, their gold holdings have surged, especially ever since the freezing and seizing of Russia's assets. Today, gold accounts for nearly 7% of China's total reserves. But it's not just China. Central banks around the world are stockpiling gold as quickly as they can. It makes perfect sense. Let me ask you, would you rather have gold, a true store of value that has withstood the test of time, that cannot be weaponized against you? Once you hold it, you own it, it is yours, it can't be devalued? Or would you rather have a paper promise by a country that has shown that they will weaponize against you, that they can come into your savings account and freeze your access, cut off your access, take your reserves at a moment's notice if you don't do exactly what they say? I know what I would pick, and I'm sure you do too, meaning that as more central banks pile into gold, demand for dollars are set to decline even further. But here's where it gets even more concerning. Even the foreign buyers that you hear about, when you look at the percentage of foreign buyers, they're no longer the traditional central banks. No, private foreign investors are now taking up a much bigger share. See, in 2022, right when central banks started to rapidly reduce their exposure to the dollar, the Fed enacted its fastest rate hike cycle in modern history. US debt, which historically had low yields, suddenly looked a lot more attractive to foreign investors. But this shift from central bank to private buyer comes with serious hidden risks. See, foreign central banks who are buying US Treasuries were buying it for a variety of strategic reasons. Long-term reserves to support trade. But private buyers are in it only for the yield. And if suddenly those yields aren't as favorable, or it doesn't make sense from a bottom line perspective, well, they'll dump those treasuries as quickly as they bought them. This exposes us to more volatility, extreme liquidity squeezes. But not only that, the United States also loses one of its biggest pieces of leverage. See, when we talk about foreign nations dumping treasuries, there's still this idea that people have, well, why would they want to do that? Wouldn't that only hurt those nations' balance sheets if something were to happen to the dollar, right? It was this insured mutual destruction idea that everyone has baked into the system. But if countries can slowly reduce their holdings of US dollars and it's private companies that are buying it, ones that no longer care about moving quickly and dumping treasuries as needed, well, that entire mutual destruction theory goes completely out the window. Without that failsafe, America is far more exposed. So the question remains, what happens with this $6.4 trillion that we are going to hit this year that needs to be refinanced? Well, as I always say, the US has two options. Option one, pay it off, which we can't afford to do. Option two, roll over the debt, essentially issue new debt at today's higher rates. Now, I'm sure someone out there is going to say, okay, wait a second, isn't the majority of this debt though short term? And you would be right. Washington doesn't want to lock us into this long-term debt at higher yields that we can't afford when our interest payments annually are already over $1 trillion or more than our entire defense budget. So this is where the pressure for rate cuts come in, right? Forget all the messaging around helping the American people buy a home. No. The reason that there has been a foot on the gas for rate cuts is because it all comes down to refinancing our debt. If rates are lower, then yields are lower, meaning we could lock in a significant chunk of debt and refinancing at a cheaper cost, just like we did in 2020 and 2021. In fact, many speculate that this is the real reason that the Fed hasn't cut rates, that it's not even about inflation, but it's about the fact that if yields drop, making our debt less favorable to buyers, then we could see demand disappear. That would, of course, incite widespread panic, something that no policymaker really wants to see. Don't worry, they have a plan for this too. But again, it involves moving away from these long-term strategic partner buyers to privatized and domestic buyers. Remember when I mentioned earlier that the majority of our debt is now actually held domestic? US banks, pension funds, private buyers, Wall Street, our entire system is riddled with buying our own debt. In fact, even Social Security, yes, the very Social Security that people talk about running out of capital, well, that trust fund owns about $2.5 trillion worth of treasuries, making it one of the largest domestic buyers of our own debt. But every dollar that these domestic buyers, especially US banks and private investors, sink into treasuries are dollars that are not going towards our real economy. No mortgages, credit, businesses, right? This hurts real economic growth. Essentially, the system is cannibalizing itself. It's using its own resources just to keep the debt machine running. But the dangers don't stop there. Banks are already awash in treasuries that have lost value since they bought them. Why would they possibly want to take on more? Well, U.S. Treasury Secretary Scott Bessent is actively working on rolling back a 2008 era capital requirement law, one that would allow banks to take on even more treasuries. That's how desperate this system is. Banks already have plenty of this asset that is worth less than they bought it. They can't do anything with it. They can't sell it, or they jeopardize showing how little they actually have. That's what happened to, of course, now failed Silicon Valley Bank. So what? Why would they take on more? Because our government needs them to. But even banks taking on more treasuries, it's not enough to keep up with this vacuum in our never-ending debt appetite. So what's next? Stable coins, right? Stable coins that are backed one-to-one by U.S. debt. You take one of the largest U.S. stablecoin issuers, Tether. They have more U.S. debt than countries like Germany. Never mind the ethical repercussions or the moral questions around a private company owning that much U.S. debt. As stablecoins are set to grow and grow and grow, what happens when that private company faces bankruptcy or some kind of management issue, or there's some reason that they need to dump their treasuries? Not only that, who actually then is running our government? If you have a private company that owns such a large chunk of our debt, they have us by the you know what. That does not scream strongest country in the world to me. And of course, we still need to wait and see how quickly these stablecoins are going to ramp up, depending on our debt needs. So if all else fails, what is the final option? We already know it is the lender of last resort, the Federal Reserve. But printing more dollars isn't free. It comes at a cost to you and to me. It is stealth default. It might not be a technical default by name, but it is stealth default by inflation, meaning that you and I are ultimately left with less. And now, in my lifetime, I haven't seen inflation reach a hyperinflation level, but I have studied currency life cycles throughout history, and we know what happens each and every time. It starts small. It starts with regular inflation, regular, as if there's such a thing. Remember, we don't even need inflation, but it starts with what we're used to. 2, 3%, 4%, 5%, right? It starts climbing slowly at first. The frog in the boiling water, right? If you put a frog in a pot of water and you turn up the heat as it's in there, it's not going to know to jump out. If it's already boiling and you throw it in, well, it knows right away, danger. We are the frog in the pot of water. And as they continue to crank up the heat, what's going to happen? It will give way to hyperinflation. Hyperinflation where you could buy a cup of coffee one day and the next day, it's double the price. And guess what happens during this period of time? Your wages do not keep up with that, right? Not even close. Meaning that you are the ones who are paying for our government's decisions. And eventually, of course, the quality of life would get so bad, it would probably be unrecognizable to anything that most of us have seen in our lifetimes. I'm not saying this to scare you. I know that got dark. I'm saying it because, like I said, I have studied currency life cycles throughout history. And we see the exact same pattern happen again and again. If you want to know more about where we are in today's timeline compared to other currency collapses throughout history, what that cycle looks like, what has happened to the fiat currencies, and how gold and silver, physical gold and silver, have protected wealth throughout these, we have a terrific resource. It's completely free. It's called the Built to Endure Report. Download your copy if you haven't already. All you have to do is scan the QR code. We will send it to you. There's also a link in the description below. But I highly, highly recommend that everyone has a copy of this because it is packed with such good information, and especially given everything that's going on today, you're going to want to know how to protect yourself. But back to the big picture, this isn't just about the 6.4 trillion coming due this year. I'm sure we're going to figure out a way to roll it all over, but the question remains, while the buyers are there, who are they and at what price? Because it is becoming increasingly clear that while we are able to keep afloat right now, we cannot tread water forever. The risk to you and I is only growing, and that is why I highly encourage everyone to make sure you have a strategy in place, one outside of the current system, right? If everything you have or the majority of what you have is in the system that is at risk and volatile to what is going on today, well, then you are not going to be able to sleep well at night because you will not be protected against what is coming next, what is already in motion today. So if you want a strategy, if you have questions, if you just want to talk to someone who understands all of this, call us at the number below.